Now we are to touch an important topic on insurance, that is seven principles of insurance. First is principle of utmost good faith. Second is principle of insurable interest. Third is principle of indemnity. Fourth is principle of proximate cause. Fifth is principle of subrogation. Sixth is principle of contribution. And seventh is principle of loss minimization. We will discuss each of these principles one by one in detail. There are seven basic principles of insurance which are as under. First is utmost good faith. Insurance contract is a contract of ubrime fide. That is a contract based on utmost good faith. It means that the standard of honesty required in insurance contracts is greater than that is usually required in most ordinary commercial contracts. According to the principle of utmost good faith, the insured must disclose all material facts regarding the subject matter of insurance to the insurance company truthfully, as the insurance company does not know anything about the subject matter of insurance. On the other hand, the insurer must provide to the insurer complete, correct, and clear information regarding the terms and conditions of the contract. The principle of utmost good faith is applicable to all contracts of insurance, that is, life, fire, marine, and other general insurances. When breach of utmost good faith occurs, the aggrieved party has the right to avoid the contract. Now we will understand the meaning of material fact. A material fact under the insurance contract means any situation, information, or fact which affect the decision of the insurer whether to accept or decline the proposal or charge an extra premium to accept the proposal extra. Examples of material facts in insurance are: in the case of building insurance, the material fact may be a part of the building is being used to store flammable materials. In the case of life insurance, example of material fact is age, previous medical history, and smoking or drinking habits of the insured person. Next principle is the principle of insurable interest. The insured must have an insurable interest in the subject matter of insurance. Insurable interest acts as a qualifying criteria for granting insurance. A person has an insurable interest in something when loss of or damage to that thing would cause the person to suffer a financial or other kind of loss. Normally, insurable interest is established by ownership, possession, or direct relationship. For example, a person has insurable interest in his own home and vehicles, but not in his neighbors' homes and vehicles. A company may have an insurable interest in the chief executive officer or other employee with special knowledge and skills. A creditor has an insurable interest in the life of a debtor up to the amount of the loan. A married person has an insurable interest in the life of his spouse. Third principle is principle of indemnity. This principle is applicable to fire, marine, and other general insurance. The principle of indemnity in insurance implies that in the event of loss, the insurer shall put the insured in the same financial position that he occupied immediately before the loss. Principle of indemnity means protection or security up to the amount of loss or insurance cover, whichever is lower. For example, a person gets his stock insured for 5 lakhs. There is a fire in the shop. The insurance surveyor assesses loss to the tune of rupees 1 lakh. In such case, the insurance company pays rupees 1 lakh and not rupees 5 lakhs. The compensation amount is directly linked with the amount of loss incurred. The principle of indemnity is not applicable to life insurance and personal accident insurance because the value of human life cannot be measured in terms of money. Next principle is principle of proximate cause. According to this principle, when the loss is the result of two or more causes, the proximate cause, that is the direct, the most dominant, and the most effective cause of loss, should be taken into consideration. The insurance company is not liable for remote cause. For example, Mr. Joseph has taken a fire insurance policy for his shop. Let us assume that his shop caught fire and Mr. Joseph filed a claim with the insurance company. Upon investigation, the insurance company found that the proximate cause of the fire was a minor earthquake in that area, which led to the collapsing of the shop ceiling upon the electric meter, which then caused the fire. Under the terms and conditions of the fire insurance policy, earthquake, which is an act of God peril, is not covered, and the earthquake being the proximate cause of loss, Mr. Joseph's claim was rejected. Here we will understand the meaning of act of God perils. Act of God perils means natural calamities like storm, tempest, earthquake, and floods, which are inevitable and affect the large area and population, and these calamities are not in the control of the human beings. Next principle is principle of subrogation. This principle comes into play when a loss has occurred due to some other person or party and not the insured. According to the principle of subrogation, after the settlement of the claim, the insurer shall be entitled to take over the legal rights of the insured against the liable third party for recovery. We will understand this principle with the help of an example. For example, air conditioner fire due to mechanical problem caused a lot of damage to your home. Fire is covered in your householder policy and the insurance company pays you for the loss suffered by you as per policy conditions. As the faulty wiring by the AC manufacturer caused the loss, the AC manufacturer is ultimately responsible for your damages. After the payment of the insurance claim, your right against the AC manufacturer is transferred to insurer and the insurer can recover the claim amount from the AC manufacturer. This is known as subrogation. Next principle is principle of contribution. This principle of contribution applies when the insured has taken more than one insurance policy for one and the same property. It means that you may be having only one vehicle and you have arranged insurance for the same. At the same time, your bank has also arranged for the insurance of your vehicle. So there are two insurance in force for the same vehicle, according to the principle of contribution. If you have taken insurance from more than one insurer, then all the insurers will contribute the amount of loss in proportion of their respective coverage. The insured cannot say that each insurer should separately pay the full loss because the insured has no right to recover more than the full amount of his actual loss. If the full loss is paid by one insurer, then the insurer who has paid the claim has the right to call upon other liable insurers to pay their share of loss. We can understand this principle with the help of an example. A person got his factory insured against fire for rupees 5 lakh with insurer A and with another insurer B for rupees 10 lakhs. There was a fire and loss was to the tune of rupees 3 lakhs. Then insurers will contribute the loss in the ratio of 5, 10, or 1 is to 2 and will be liable to pay rupees 1 lakh and 2 lakhs respectively to the insured person. That is, in the case of insurance company A, sum insured was 5 lakhs. In the case of B insurance company, the sum insured was 10 lakhs. Loss is total rupees 3 lakhs. So when we are to calculate, so the total is sum insured in the case of A plus B is 15 lakhs. So we can say that out of 15 lakhs, the loss is rupees 3 lakhs. So we will have to calculate accordingly. That is, against 15 lakhs, there is loss of rupees 3 lakhs. So when the sum insured is 5 lakhs, 1 lakh, and then here it will be 3 lakhs divided by 15 lakhs into 10 lakhs. So you can understand that the insurance company A will be liable to pay rupees 1 lakh and the other will be liable to pay rupees 2 lakhs. Now comes the principle of loss minimization. This principle states that it is the duty of the insured to take all reasonable steps to minimize the loss to the insured property on the happening of uncertain event. Suppose goods kept in a storehouse catch fire. Then the owner of the goods should try to recover the goods and save them from fire to minimize the loss or damage. The insured must behave with great prudence and should act as if he is uninsured. The owner should have called the nearest fire department office or and using fire extinguishers extra. We may add that we have already uploaded courses on email writing, present tense, future tense, past tense, cybersecurity, letter writing, most common mistakes in English grammar, business studies, DBMS, information technology, web applications, and much more. You can look for the same on YouTube, Google, our own website, Udemy, Tutorials Point, and other websites. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.